Hi everybody. Very pleased to meet you. This is Amaury here from eFounders in Paris, and super happy to be hosting this session together with Anna from Index Venture and Michael from IVP. I think we're super happy to have this panel today, which is right on spot of a like super important topic for everybody in the tech ecosystem. Where does the fundraising market stands? That's a big question. Not sure we'll have one single answer, but I think that there will be a lot of interesting topics covered today, and hopefully it will give you some clues on how to best run your companies. I think we have around 50 minutes together. We'll start with a quick intro. Then I think we'll have a few topics to cover, and then maybe finish with around 10-15 minutes of Q&A. I think you can already ask questions directly in the chat, but you can also save them for the Q&A session. Maybe let's start with a quick intro. Anna, Michael, and then myself, and then we get into it.
Sure. I can kick off. So I'm Hannah. I'm a partner based in London at Index Ventures, who are a multi-stage venture capital firm. We've been around for almost 30 years. We started off in Europe, but now we have 3 different offices: London, New York, and San Francisco. And we invest across all stages, from pre-seed all the way up to pre-IPO, and across B2B and consumer businesses. We've been a very happy investor in Spendesk from early on, and as well as a number of other great businesses, including Figma, Adyen, Notion, and many others.
Awesome. I'll go next. It's great to be here, everyone. I'm Michael. I'm a partner at IVP. And just quick background on the firm. We're a growth stage venture capital firm that's based in San Francisco that invests across the US and Europe. The firm's been around since 1980. Since then, we've been fortunate enough to partner with over 400 companies, and given our later stage focus, about 131 of them actually gone on to go public. We can invest as early as a Series A. We can also invest all the way up to an IPO. And even into the public markets. But generally speaking, our bread and butter really is leading the breakout sort of Series B and Series C round. In the last 3 years, we've been very active in Europe, and it's one of our major geographies where we concentrate our investment dollars and focus. We back companies like Ivan, Supercell, Klarna, Wise, Hopin, Supermetric, Sion, Verif, So Rare, and many others in the past. And we're looking forward to doing much more in Europe going forward. Quick background on myself. I've been with IVP now for the last 7 years. I help lead our European and software investing efforts. I've been fortunate enough to partner with founders at Sion, Verif, Grammarly, Ivan, Curology, H1, CrowdStrike, and many others during my time at IVP. And before I came to IVP, actually, I spent several years working at Dropbox in their strategic finance team. And I think because of that training, I tend to see the world through the lens of a finance operator. And before that, similar to maybe a lot of folks in in venture capital, started my career in investment banking and did my undergrad at UC Berkeley.
Thank you so much, and thanks for this impressive panel of companies that you invested in. And briefly on myself. So I'm Amaury. I'm a partner at eFounders. So we're a Paris and Brussels-based startup studio. So at the opposite of the spectrum compared to Michael. So we start companies. So we are there before the seed, before the pre-seed. We are the ideation stage, and we partner with entrepreneurs to start B2B SaaS and fintech companies. We've been operating now for 12 years and started around 35 companies, amongst which Spendesk, which is hosting us today. And I'm still a board member at Spendesk, so super happy to be here today. So as for me, I don't really know the funding market because I'm more on the operator side and not on the investor side. So I'm super curious to everything that's going to be said today. So thanks again, everybody, for being with us today. And feel free to shoot your questions also along the discussion if it's useful. So we cut the discussion in like 3 big parts. The first one will be what's our understanding of the state of the funding market today. Then we will try to discuss what impact do we see or expect on the companies, on the VC-backed companies. And the third one is what kind of levers can we think of at the company level to mitigate this environment. I think some have already been discussed in another panel, so maybe we'll spend a bit less time on this third part. So maybe starting with a relatively broad question, what's the current state of the market, of the funding market, across different stages? We can see a lot of different stuff. Read on Twitter that seed has become hot again, but the growth market is closed. What do you guys see? Anna, what do you see?
Yeah, so as you say, it's definitely a different market depending on the stage at which you're looking at. So, we see that the seed market is still pretty active. And I think that's for a number of reasons. One, in the early stages of building a company, you're mainly building rather than selling. So you're sort of more immune to, macroeconomic shifts and less reliant on people buying your products as you're still sort of building and hiring in those early days. And I think the other thing is, obviously when you invest at the seed stage, your time horizons are 10 years. You're not kind of reliant on the IPO market opening up in the next year or two. So you're much more able to have those sort of long-term time horizons. And I think, the third thing is that we've seen is that many, generational companies like Stripe, like Airbnb, like Uber were built out of, in difficult economic times. And those are the times when often, it makes sense to build a company. The risk reward is different. You're able to hire great people. You can shake them loose from their existing companies more easily. And, if you're mission driven, you're not deterred by a more challenging macroeconomic environment. It's your life's mission to build this business. So whatever's going on in the economy, you're still going to go out and build it. So what we're seeing at Seed is, maybe a slightly, fewer companies coming to market, but the companies that are coming are, generally the sort of companies that we like to invest in. Mission-driven founders, in it for the right reasons, long-term thinking. And, I think that, it's a really exciting time to be sort of starting businesses and investing in early stage businesses. At the later stage, and I'll let Michael comment a bit more, it's definitely, slightly quieter. I think it's for a number of reasons. Obviously, the IPO market is very quiet, but also a lot of businesses raised huge amounts of money last year and now have these war chests, which they're not even close to deploying, and, have runway for at least another sort of 18 to 36 months, but are also taking measures to increase that even further. You see many companies doing layoffs. Even, the strongest, best companies that are still hitting their budgets are all sort of making sure that they're as kind of efficient and lean as possible and extending that runway that they got last year. So, I think that's one of the reasons why we're just seeing, less activity at the later stages. But I'll hand over to Michael to share his thoughts.
Awesome. Thanks, Anna. And what you said is totally right. We've seen pretty substantial multiple compression in the public markets, and it's yet to fully make its way to the private markets. What we typically see is that the private markets tend to lag the public markets by, call it 2 to 3 quarters on average. And it starts to adjust from the later stage down, right? So it starts with pre-IPO companies, then works its way down to sort of B, C's, seed A, and touches seed last. So that's typically the order of operations. And I think Hannah's totally right. What we're seeing in growth is that the funding market has slowed significantly this year, but it's starting to thaw a little bit, starting to pick back up in terms of overall activity. Hannah's totally right. Lots of companies took advantage of the fundraising markets in 2021 and have massive war chests. They don't need to raise. And the way I'd sort of characterize the late stage market right now is that it's a bit of like a bid-ask spread problem in the world of venture capital. I think we're in an environment where, what startups think they are worth is currently very different than what some VCs are willing to pay. And as a result, given just the strong cash balances that I think you're seeing at a lot of startups, there's been really limited price discovery. So we're still in the early innings of this. It'll work through, but we'll know a lot more, I would say, in the next couple of quarters.
Okay, thank you. Super interesting. So just to understand a bit more on the growth market, so the later stage market, if I hear you, it's more of a demand problem. So companies are not really in demand because they know the market is frozen, and they have them, like most of them, huge balance sheet, thanks to the last 2 years. It's more of a demand problem than an offer problem, correct? You guys would be ready to put, I don't know, a 100 million Series C if a good company were to come and with reasonable expectations.
Absolutely. No, if the valuations were right, and I think in line with what we're seeing in the public markets, we'd absolutely be extremely active. So I think that characterization is absolutely right.
Okay. And last question maybe around that is, do we see like proper rounds replaced by bridges? So like by smaller rounds to extend and wait, and do we see that a lot? I see that a lot between seed and A, but do we see that also at later stages?
I'd be curious what Hannah is seeing at the early stages. I can speak sort of to what we're seeing in growth. It hasn't really happened yet. I think what you're seeing more actually is, lots of, call it, Series C plus companies, tapping investors that maybe they spoke to in the last round, offering to do, extensions to the last round at the same price. I think that is much more common. But we haven't seen, the prevalence of, many proper bridge rounds yet. But again, we're super early into the cycle, and things may be very different in the next year. But it's mostly sort of extensions to the last round that we're seeing versus proper bridges. But I'd be curious what Hannah's seeing at the earlier stages.
Yeah, we're seeing similar to Michael at the later stages. At the earlier stages, we are seeing more bridge rounds. And I think, that's a product of, in 2021, you could raise a Series A with sort of no to very limited traction, sometimes pre-launch, pre-revenue businesses. Whereas now what we're seeing is the bar for raising a Series A is a lot higher. You typically cannot raise a Series A without, at least having launched a product. Better if you've got revenue, getting closer to what it was in 2019, 2018, which was like, roughly $1 million of ARR to raise a Series A. So, and a lot of the founders that raised their seed rounds sort of last year or the year before didn't necessarily have those benchmarks in mind as they started building their businesses. So a lot of them have sort of raised those seed rounds, but are not yet, ready to raise the Series A. And so are raising bridge rounds to sort of bridge them towards those milestones. They may have sort of early shoots of product market fit and some early customers, but they don't quite have those Series A metrics. So, and I'm guessing you're seeing something similar, Amaury, which is, seed funds and multi-stage funds coming in, doing these sort of seed plus rounds, and, bridging those seed companies so that they can get to the milestones to raise a strong Series A.
Okay, super clear. Thank you. And so the obvious question is, you guys have huge amounts of dry powder sitting in your pockets, so there will be dust on it. What are you going to do with this? Not you, if you don't want to talk about yourself, but how the market is going to put this money in movement in the next months?
Sure, maybe I'll take the first stab at this. So that is sort of the confounding thing about this current market environment that we're in. Again, there's sort of a bid-ask spread problem in terms of pricing expectations between founders and VCs, but VCs are sitting on record amounts of venture capital dry powder that does need to get deployed over the next several years. I believe the latest stat is, as of sort of Q2 2022, there's $290 billion of venture capital sitting on the sidelines. So that is an enormous amount of capital that needs to go fund startups. I will say that there are a few caveats that I would sort of put when people throw out that $290 billion number. I think the first is that a lot of that capital is likely to bias towards earlier stage investment opportunities where the valuations might be more in line with the current market and weren't as impacted by call it the 2021 valuation environment. I think you're going to see also a lot of VCs allocate a lot of that dry powder to reserves to support existing portfolio companies. And I think the one thing I'd call out too is that in the same way that it's harder for startups to raise capital from VCs now, it's actually harder for VCs to raise capital from their LPs. So what that means is that, I think fund cycles will extend. VCs are going to be a lot more, I think, prudent in terms of capital deployment. And the reason why is I think, every LP that is deploying dollars into venture capital funds, they're dealing with what's called a denominator problem right now, which is, the value of all their public assets in their portfolios have gone down dramatically, and they're, over allocated to things like VC. So, we're at the partnership level at most venture capital firms, that's something we're being very, very mindful of. So, tons of capital, but it's got to last. Capital is really precious in this environment. So that's how I think a lot of venture investors are viewing it.
Yeah. I think there's going to be a bit of a bifurcation. So I think you'll see more capital being deployed at the earlier stages for the reasons we mentioned. And then I think what we'll see, and what we're sort of already seeing a little bit, is some of these crossover funds that, last year were investing a lot in private markets and now going to shift their focus to investing, much more heavily in public markets where, the multiples look more attractive when you're comparing sort of a 5x multiple in the public markets to still a sort of 50x in the private market. So I think we're seeing that capital being allocated more to public markets, and we'll see a bit more of that in the future as those valuations seem sort of relatively cheap, at least sort of in the short to medium term.
Okay, super clear. Thank you. So if I hear you well, it's mostly a pricing problem. Founders are too greedy. Yeah, they have not landed yet.
I wouldn't say that.
You guys are ready to shoot.
No, I wouldn't say founders are greedy. I think, a lot of founders, especially first-time founders, their first experience raising capital was in 2020, which was a very, very different market environment than we're in now. So I think the world has changed. I do think a lot of founders are getting the message and sort of coming to terms with it. But I wouldn't say founders are greedy. I think, their first exposure to, what the market was in a really peculiar time in the last market cycle.
Okay, thank you. I wanted to talk about a small topic, which is a secondary market, because it seems that the secondary market has dried even faster than the growth market. At least it's my perception. So I would love to have your perception on that, and also what are the implications for investors and for companies, especially when dealing with like employee liquidity issues, because it was one of the hottest topics last year, and now suddenly nobody can make any secondary, and employees are stuck with their options or shares when they buy them. Is it also just a pricing problem, or do you see this market like really blocked for a long duration? Anna, what do you think of that?
Yeah, I think it's quite true that the secondary market is not as active as it was last year. That's not to say it's dead. We are still seeing some secondary transactions happen. And I think, my sense is that we may start to see M&A pick up quite a bit over the next sort of, year, especially sort of, I hate to say this, but given the value of the pound and the euro, and I think many US companies are going to see European businesses as relatively cheap in this environment. And we may start to see a lot of US headquartered businesses start to increase their M&A activity in Europe, which will provide a liquidity event for employees. So I don't think there's sort of no hope for any liquidity for employees over the next few years. But I think it will probably more likely come from actually M&A transactions than it may do from secondary transactions.
Yeah. I think, Amaury, I think you were asking, sort of why I think things are slower. I think it's really twofold. I think you hit it with, one, there is sort of a valuation question that I think everyone is working through, but there's also an illiquidity question that I think everyone's working through as well. Secondary stock, it's not publicly traded. It's not liquid. You can't sell it. So, if you look at it through the vantage point of investor, why would I buy, illiquid stock in a private company at, 100x ARR in the private markets when I can go buy Datadog at 20x ARR in the public markets to be able to sell that instantly if the stock appreciates. I think it's a sort of a risk reward question that a lot of investors are sort of thinking through. And in terms of how I generally thinking about it, like I think we are headed into a world where there is a lot more capital scarcity, and in that world, I think it's probably more prudent for founders to add more primary capital to their balance sheet versus taking chips off the table. Generally speaking, I think in the last couple of years there was a surplus of capital, and as a result, generally speaking, investors were willing to put in much more capital than the company actually needed, which created room for secondary in a lot of the rounds that we saw. Going forward, that may no longer be true. So just food for thought for founders that are sort of thinking through secondary implications.
Fair enough. So maybe one advice for founders would be to organize themselves and maybe the communication with employees and so on in a world where secondary liquidity is scarce for another few quarters or years.
Yeah.
I hear you on that. Okay, excellent. Super clear. And maybe last thing about like general state of the funding market. Could you tell us a bit more about how you believe the market is going to unfold over the next quarters, and what opportunities you as a fund index or IVP would like to see? Is how you would like to deploy your capital? You want to accelerate? You want to refocus on other stages? I mean, do you have like a exit plan for the next quarters?
I mean, for us, we'll stick to our knitting. Our business is to invest in great founders building, enduring businesses for the long term. So, we'll stick to that. We'll continue to have a high bar. There's definitely more of a focus on strong unit economics. Businesses that consume a huge amount of capital are definitely less attractive. But overall, our mission and our investing will remain broadly the same.
Yeah, my answer is the same. Our fund strategy is going to stay constant over the next few quarters. And, our mission really is to back the 10 to 14 best, call it Series B plus companies we can find every year, regardless of the market cycle. I think it's important to remember that, the venture capital asset class is driven by what's called the power law, which means that it's really the home runs that really drive returns. And if you stop investing, if you slow down, you just don't have a shot at partnering with those outliers that have a major impact on your fund. So, regardless of where we are in the market cycle, and in bull markets or bear markets, I think, our strategy at IVP is to continue investing at our target pace of, call it 10 to 14 investments per year.
Okay, thank you very much. Maybe take one or two questions from the audience now. Michael, you were talking about Series B onwards. One question was, what level of ARR would you suggest for a Series B? I guess it will be a large spread, but what are the general numbers you're currently seeing?
Yeah. I would say most Series Bs that we've seen are typically, and this is going to be a wide range, but feel free to use the average, 5 to 15 million of ARR, I think is generally, what I would describe as Series B range. The average tends to be sort of a company that is approaching 10 million of ARR. I think generally is a good candidate for a Series B. But that being said, we've seen this rule get broken frequently. There are pre-revenue companies that raise Series B, so it's not always a hard and fast rule. But my mental framework is generally 5 million on the low side, but generally something between 5 to 10, maybe.
Okay, so it has increased a bit compared to maybe the last 2 years.
Yeah, that's right.
Yeah. Anna, do you see the same ranges in the?
Yeah, it's similar. I mean, we do some early B rounds where it's more like 3 million of ARR, but obviously in that situation, you are looking for maybe a stronger growth trajectory, right? So it's a balance between sort of the ARR and also the growth of the company. But yeah, I'd say sort of 3 to 10 is typically what we see. Would love to do a Series B at 50 million of ARR. If you got any of them, Michael, send them over.
Okay, thank you. And another question was about your opinion on the rise on the alternative financing options. Revenue-based financing is mentioned there, but I guess there's also venture debt and so on. Do you see that as a kind of credible alternative to like primary capital? Is it a threat for your business?
We don't see it as a threat. The founders that we work with tend to work with us because, in addition to the capital, they also want, a board member, a strategic advice, or the resources that comes with a venture capital firm, like support on like talent and communication and, various other strategic topics for the business. So it's definitely not something that we see as a threat. It may make sense for certain businesses. I think it can be quite dangerous for some businesses that are nowhere near close to profitability, and in this interest rate environment, I think businesses need to be very careful about saddling themselves with too much debt. But that's not to say that there isn't a time or a place for it or for a certain type of business, but we wouldn't recommend it to all of our companies for sure, especially with this uncertainty, right?
Yeah, I think Hannah nailed it. I don't have too much to add beyond that. Completely agree with everything she just said.
Okay, thank you very much. What I suggest now is that we moved a bit to what you are seeing in your portfolio companies, or what you maybe expect to see. You both of you have a lot of portfolio companies, so I think it's interesting to have this kind of aggregated perspective across the different companies. One question I had is, how do you see the company's top line or growth impacted? Do you see like revised forecasts? Do you see longer closing cycles? Do you see more churn? Do you see less expansion? What's kind of where will be the problem, if any?
Maybe I'll start. I mean, we're seeing all of the above. I'd say there are first, second, third order impacts when the capital markets dry up. When there's less capital, companies are forced to be more efficient. When companies are being more efficient, they spend less on things like software. When they spend less on software, that impacts the revenue of their vendors. That causes their vendors to be more efficient, and the cycle just goes on and on and on. So it's absolutely happening. There are a handful of companies that are continuing to grow, beat plan in this market environment. But I would say many of the companies that we work with, and also that we're currently evaluating, are seeing some short-term headwinds. I think that's normal in this environment.
Yeah, I'm in the same place as Michael. I mean, when we speak to CFOs in our own portfolio, they're telling us, they're going line by line, looking at every bit of spend in the portfolio, looking at, headcount, but also like every bit of software that they're buying. Is it necessary? What's the ROI attached to that? Right. So that has, knock-on effects on software companies that are trying to sell to these businesses. Right. So of course we see longer sales cycles, lower upsell, higher churn. But there are also businesses that are thriving in this environment and, beating their forecasts, and, growing even faster than we expected. So it's a real mixed bag, but we are definitely seeing the impact of the macro environment in many of our portfolio companies.
Okay. Are you guys refocusing your investment, or the companies you're looking at to invest on companies that are more resilient, or let's say less prone to the number of seats or whatever, or more mission critical? How would you assess the resilience of potential companies?
I can just briefly comment on this. I think when we're looking at kind of net new investments now, what we really think about is this a must-have or a nice-to-have? Because my view is, in this environment, no one's buying nice-to-have software, right? It's the must-have stuff that gets bought. So that's really the sort of the way that we think about it. Like, is there a clear ROI to this for this piece of software or whatever it is that you're selling? And if not, it's going to be a tough business to ride through the next few years. both on the B2B side and the consumer side, right? Like consumers are being squeezed from every angle. So anything that's not sort of, equally kind of a must-have for consumers is going to suffer too. So that's sort of the lens at which we're looking at businesses at the moment.
Yeah, I mean, from our perspective, things haven't really changed all that much. I mean, probably similar to Hannah, we only try to partner with companies that are selling mission critical software by definition. So that part hasn't really changed. I think as a firm, we've always sort of biased towards companies that have capital efficient growth. We tend to look at that as like a proxy for market pool. So I don't think that has really changed. So I think in terms of what we're looking for and the types of companies we're looking to partner with, there hasn't actually been a material change in response to this downturn.
Okay, super clear. Thank you very much. It seems like to extend a bit on what you were discussing about how to reduce cost and increase the runway for companies. It seems that in the US we're seeing a lot of layoffs or team size reductions. It seems less frequent in Europe, at least from what I see. Maybe we can discuss that because you have both perspectives. And maybe can you help tell us about what's the percentage roughly of your portfolio companies which are like freezing hires, laying off? If yes, in kind of which functions are the targets of the layoffs? Not an easy topic to discuss, but there's a lot of information bias in this stuff because we're only seeing the company that lay off, but it might be just a very small chunk of the companies. Yeah, so I don't know, maybe starting in the US, Michael.
Sure. Happy to comment on that. I mean, I'd say many of our companies are taking advantage of this downturn to get more efficient. Like even the ones that are beating plan, super well capitalized. I think we're in an environment where it's no longer taboo, right, to get more efficient. Whereas in 2021, it felt like it was, and it was potentially a sign of weakness. I think every company is doing it, even the best capitalized ones are. Even if you look into the public markets, I think about some of the most profitable technology companies of scale, like Facebook or Meta. They're doing hiring freezes, they're doing layoffs. So if they're doing it, it's not unrealistic or crazy that a earlier stage startup would as well. But you asked the question in terms of what functions tend to be most targeted. I would say where we're probably seeing it most is for underperforming employees in the go-to-market division. I would say I think there's a lot more just performance management that you're seeing relative to in the past, and also I think recruiting I think tends to be a department that is probably seeing some of the most pressure. But those would be the two for me.
Yeah, so we see the same, and also marketing. I think as businesses are being more cost conscious, they're looking at the ROI on their marketing spend and seeing that most of it or much of it is pretty inefficient. So we are seeing quite a few layoffs across, marketing teams, as well as companies, seek to trim down their marketing spend and perhaps don't need such big teams. But, the truth is most of our businesses are, if not doing layoffs, really looking closely at, as Michael says, like, are they as efficient as they possibly can be, and using this downturn as a good opportunity to make sure that there's no fat in the organization, right? They're lean, and, that everyone is an A player, and that anyone that's sort of not, that exits the business and they remain a sort of high performance team. So, I think a lot of businesses will emerge from this much, much stronger than before, with much better performing teams. And they can probably make layoffs of 10% and not notice any difference in performance. If anything, it improves, right? Because morale improves sometimes, and you energize the people that remain. So it's not taboo. It's very common. But we see companies making layoffs in certain departments and hiring more in others. So it's not kind of mutually exclusive. There may be fat in certain parts of the organization and others where you want to invest for growth. So in some businesses, we see both at the same time.
Okay, thank you very much. When you're looking to invest in a company, are you looking now at different metrics than what you used to look at? And And if yes, what would be the advice for the CFOs we have today with us to really get prepared the best way possible to get the company ready to raise?
I mean, I don't think we're looking for anything different than we used to, right? We're still looking for, top line momentum, evidence of product market fit, a killer team, a huge market opportunity. I don't think that has changed at all. And I don't think that will change for investors going forward. I would say like the only tough thing again to bridge is just the question of valuation, again, which is something that is getting worked out in real time. But not a whole lot has sort of changed in terms of, our underwriting, at least.
Yeah, there's, it's not that, now we're only investing in profitable businesses. Like that's not the case at all. But there is definitely more of a focus on unit economics, and such that we can see a path to profitability, not necessarily profitability today or tomorrow, but something that resembles a business that will get there at some point. And as Michael says, businesses that are not, incredibly capital intensive. So, but I don't think that's changed a huge amount. It's just maybe, a little bit more kind of under the microscope now.
Okay. Thank you. Any tip or like obvious advice that we should give to the CFOs around us getting ready to fundraise?
Let's see. I mean, I think a lot of it is going to be working in concert with the CEO. I would say, that again, with the amount of dry powder that is currently on the sidelines, like capital is still certainly available. So instead of sort of blasting, every venture investor, I would still keep the circle small. Again, I think the number one most important thing in terms of picking an investor is just the chemistry and the relationship that you have with, the person that you potentially may bring onto your board. So I think that would sort of continue to be my best advice. Be very conscious of the partner that you're bringing on. As a CFO, obviously, being very prepared, having a data room ready to go, anticipating a lot of the questions that venture investors are going to ask, which you can certainly tap your existing board members and investors to help with, I think is great. But again, I would just counsel everyone to, pick the right partner, pick the right firm. Again, in an environment like this, don't over optimize for valuation, but also know that is important.
Yeah, very similar to Michael. I mean, I think what we're just seeing in this environment is that the CFO is being elevated sort of to such a, important role. I mean, always has been, but, investors definitely, I think there's even more for investors, even more focus on, the CFO ensuring that, there's such a good handle on, the drivers of the business, the unit economics, the path to growth and profitability. And, just a kind of line of sight to, a best and worst case scenario. Like, make sure that you're sort of sharing that, like, you're aware of, you're always selling the dream a little bit in a pitch meeting, but I think a sense of realism and thoughtfulness around, there is macroeconomic uncertainty. We're prepared for that. Our projections are conservative, and just ensure that forecasts reflect, the macro reality, because it is an extremely uncertain time. And I think, investors are looking for CFOs that they feel are sort of prudent, conservative, and, really a sort of, have a very strong grasp of the business and able to kind of move levers as the environment shifts.
And what Hannah's totally right. I mean, I just, one other comment to make is that, like, this really is the time to shine for a CFO. During a market downturn, the CFO is by far one of the most influential executives at a company, and can really steer the company, so even beyond fundraising, into whatever direction they see fit. And I think like the biggest mistake I think a lot of companies and CFOs will make during this downturn is rushing to profitability way too quickly. I think CFOs and CEOs definitely need to remember that just, it's not good enough to just survive the downturn. Like what you actually want to do is you want to exit the downturn in a position to continue delivering compounding growth at scale. I think that's ultimately the North Star. And I think, CFOs that realize that and also are able to communicate that to the board or to a new investor during a fundraising round. I think those are going to be some of the star CFOs that we see during this downturn.
Okay, super clear. Thank you very much. That's interesting. Yeah. So you're also now valuing the fact that companies are down to earth in their forecast, maybe not too bullish, so that they show they have really understood what's going on, what's really going on. Yeah. Well, yeah. Maybe one last question. I had a lot of others, but time is running. One last question is about how do you frame the growth versus profitability dilemma? Because valuation, at the end of the day, valuation are still tied to the revenues in most cases, okay, because it's a multiple of revenues. So growth, of course, counts for valuation. Yeah. So how do you frame this topic? Yeah, I find it super difficult.
Maybe I'll take the first stab at this. I mean, so we have this framework at IVP called, the Maslow's hierarchy for growth stage CFOs is kind of what we call it. And you sort of just imagine sort of, the Maslow's pyramid. And at the very bottom, like the number one most important thing by far, obviously, is cash runway. Like cash is oxygen. You need to make sure you have it. Then above that is, having a durable core business that is growing, right? Focusing on that. And then after that, it's a viable second act. Then it's profitability. Then if you do that, you're on your way to becoming an enduring technology company. I think the mistake that we see companies make and, what we counsel against is, again, just jumping to profitability way too quickly before you have an act 2 in place and new S curves that can help you continue to compound growth at scale. I think, again, if you sort of come out of this downturn, growing 5%, but you're super profitable. I think that's a company that I think is great, but may not have reached their full potential, because at the end of the day, compounding growth is ultimately what matters. So that's the thing that I think we just want to make sure that the CFOs have in mind, that that's the North Star that you should be focused on during this downturn. But that being said, cash is king. Cash runways are important. Make sure that you're able to survive as well.
Yeah, 100% agree with everything Michael said. You got to survive first of all, and then yeah, grow. I'd say it's not profitable growth that we need. It's growth with good unit economics with a path to profitability. Yes. We do not need to invest in profitable companies. Most of the companies we invest in are not profitable at the time at which we invest in them, and that's okay. That's why we're there to invest in them, right, and to fuel that growth. But we want to see an eventual path to being a profitable company. So, they perform well, at IPO and beyond. Okay,
thank you very much. It was super interesting. I think I'll jump to some of the questions that we had through the platform. Anna, you mentioned M&A, and we discussed M&A. We discussed exchange rates, like a super strong dollar and weak euro and weak pound. My question was, what kind of deals do you see happening in the next 12 years? Will it be like Series C or Series A companies struggling to raise the next round and then getting sold to Series C companies? Do you see like huge deals, distressed deals, opportunistic deals, or strategic deals? Like there are a lot of different ways we can think of M&A these days. Some companies have piles of cash, some are struggling to raise. How do you see this unfold, and maybe what kind of opportunities do you see in your portfolio companies? Yeah.
All of the above. I think we're going to see a little bit of everything. I think what you will see a little bit of is, not so much on the acquisition side, but more sort of mergers of businesses that are going after the same customer base, so that they don't have, any investor that invests in consumer businesses will know, the constant battle to acquire new businesses, spending, getting out of control on paid channels, Google, Facebook, Instagram, TikTok, whatever it is. If you've got two businesses that are, both spending, extortionate amounts, both trying to go after the same customer, I think we will start to have some of those conversations around, does it make sense to sort of merge these businesses so that you can sort of consolidate some of that spending and not be sort of bidding each other up? So my hunch is we will start to see a little bit of that coming through especially on the B2C side. And then, on the B2B side, all of what you mentioned, I think some early stage businesses that don't quite get to the milestones that they need for the next round, that are strategic assets for other larger companies. I think you'll see some roll-ups happening across certain sectors. So I think there's going to be a whole host of activity, but we'll see. It should be an interesting few years, I think, in this space.
Yeah, plus one to everything that Hannah said. I think it's going to be increased. Like M&A is going to be increasingly a buyer's market, I think, going forward. So there's going to be lots of opportunity per what Hannah said. That being said, I think what we counsel sort of CFOs and CEOs on regarding M&A is that it can sometimes be a very unnecessary distraction, just given how hard it is sometimes to integrate some of these companies and retain teams. I think it's just really important to understand the ROI of what you're buying. I think you need to have a really good point of view in terms of whether or not that acquisition actually meaningfully accelerates your roadmap. We, always push our companies to do a build versus buy analysis to see if it's actually cheaper to buy versus build, and also taking into account just the opportunity cost of the entire team to integrate the acquisition, and also the opportunity cost for engineering time. But it's going to be a lot more common, for sure. I mean, there are a lot of extremely talented teams out there that, for whatever reason, didn't hit, the milestones that they needed to, and are going to be looking for a home. So it will be increasingly common.
So go for it, but beware of the defocus.
Yeah, exactly.
It's not the priority. Okay, thank you very much. That's super interesting, and indeed, I think we're going to see a lot of super interesting moves in the next quarters. And maybe to close the discussion, last question. Any tips or best practice on how you change the mindset and the culture of a full organization towards more frugality, ROI, and so on? Because a lot of people have taken very bad habits. As a CFO, as a CEO, how can I drive this movement here?
Yeah, it's a really good question. And, we hosted a CFO dinner a few months ago, and that was the biggest question on most CFOs' minds, right? Which is, people have been used to, free spending, being able to buy any piece of software that they thought looked interesting. And now we're asking them to put together a business case for everything that they buy, and they're sort of stumped and asking the questions. So it's definitely a cultural thing. I think it needs to come from the top. I think, it's where the CEO and CFO jointly need to sort of step up and show that great leadership, and, be able to sort of, impress upon the company why it's so important, and, sort of existential to behave in this way, right? But also maintaining kind of morale at the same time. You don't want to be a sort of doomsayer. So it's a fine balance. But I think a dose of realism for the whole company, that great businesses are built by being responsible and frugal and focusing on good economics, I think is important. And I think the employees will eventually come around and realize.
I mean, for me, I completely agree. I think it starts with having the right controls in place in the first place for spend, right? So quick plug for Spendesk. It's an awesome tool to drive this sort of change. You can't control what you can't measure. So I'd encourage every company to make sure you have the right sort of systems and platforms in place such that you can help control spend. So it's a combination of culture for sure, but it's also making sure you just have the right processes in place, right? And tools like Spendesk certainly enable that.
Okay, thank you so much. A tough one for the CFOs there, but super interesting on their role and how they can move the culture of their company. Thank you so much. I think it's quite a positive quite a positive framing of what's happening. So the market needs to lend, but there is money to be invested. You're still looking at investing in interesting companies. So yeah, go for it. And thank you so much for your time. I hope it was useful for everybody. I personally learned a lot of interesting stuff. So yeah, thank you very much, Anna and Michael, and see you soon.
Thank you.
Thanks for having us.
Thanks. Bye bye.